thesis that we built a global macro investor, that we actually now run our portfolio for XPAN, investing in the very best hedge funds. We use this everything code as the basis. And it's the one where I discover that the debasement of currency is kind of everything and how it's very cyclical and it's understandable and forecastable as far as we can tell. Obviously, things can change. Nothing is a pure, perfection. But I think this is right, and it seems to be proving itself out right.
Like many crypto fans, Raoul Pal, a famous macro analyst and former Goldman Sachs executive, is very optimistic about the prices of crypto assets in 2024 and 2025, before the cycle ends. He thinks that the total value of all crypto assets will reach $12 trillion, which is 4 times the current range of $2.65, $2.7 trillion. This will easily cause individual crypto prices to reach new all-time highs. Pal wants Bitcoin to reach at least $200,000 before the cycle ends in 2025. Price increases this big for Bitcoin will naturally affect other cryptocurrencies, which is why Pal is even more optimistic about top cryptocurrencies like Ethereum and Solana. Pal, a former executive at Goldman Sachs, thinks that Ethereum will top this cycle at $8,000 per token and Solana will top at $11,000 per token. He is usually bullish on all crypto assets and technological stocks, which he says are the only real winners of the exponential age. Crypto is by far the best financial opportunity that has ever been given to regular people. Not only does it give regular people a chance to get ahead of the debasement of fiat currencies, but it also gives them a chance to even out their investments in a way that they can't find with any other asset class. Watch clips from Pal's most recent video broadcast where he talks about his predictions and outlook for the cryptocurrency industry in 2024 and beyond. But first, please take a moment to like this video, subscribe to the channel, and turn on post notifications to see more videos like this. You can also join the conversation by leaving your thoughts and comments below. Everything you do helps the YouTube algorithm and greatly helps the growth of the channel. Thanks, and enjoy the video.
Now, to set this up, you're all here for the Festival of Learning. And it's all generally about crypto and how we look at crypto and macro together to give us what we're looking for. And I'm trying to teach you how I look at this. And there's a lot in this. There's going to be a lot of charts to run through. But I think it'll give you a very cohesive picture. And what I want to get across to you today, this is the biggest macro opportunity of all time. I've basically dedicated a lot of my life to this trade now. And many, many others in the space, particularly macro players, have basically just given up trading other instruments and just gone towards crypto because the world, driven by the everything code, is basically all one trade, the debasement of currency by the central banks. And therefore, you want to own the best performing asset. And if the world is that simple, it really does make things much easier for us. Now, this is not for everybody. Not everybody wants to take the kind of risks, but this will give you a very good idea of why this is the biggest macro trade of all time. Now, when I first wrote about it in GMI back in 2012 or 13, I said it then. And I stupidly should have just dropped everything and just done this one trade, but I didn't. But really, I've been in it full time since 2020. The sell-off in 2022 was the opportunity I was looking for to add to the trade. I don't believe that if you've got a long-term view, you should really trade around it. You should just keep compounding. But others think differently to that. And I don't know what I'll do this time around. I'll probably take some lifestyle chips off and continue to run the trade. This trade is the biggest macro trade of all time. And it's not just about this cycle. It probably goes into 2030 and maybe well beyond that. So it's a big one. So anyway, pay attention, everybody. I'm going to start to go through the charts of why this is the biggest macro trade in history. Firstly, I'm going to start with the everything code. The everything code is the proprietary thesis that we built a global macro investor, that we actually now run our portfolio for XPAN, investing in the very best hedge funds. We use this everything code as the basis. And it's the one where I discover that the debasement of currency is kind of everything. And how it's very cyclical and it's understandable and forecastable as far as we can tell. Obviously, things can change. Nothing is a pure, perfection. But I think this is right, and it seems to be proving itself out
To
right.
show even more of the huge opportunities that crypto offers in 2024 and beyond, Pal shares a chart that was first shared by Jaron Timmer, who is the director of macro at Fidelity Investments. According to Timmer, the chart puts Bitcoin's volatility in perspective by showing the risk-reward chart for the pandemic-post-pandemic era between 2020 and 2023. It displays the risk-to-reward ratio for various asset classes and alternative asset classes, such as gold, cash, treasury, inflation-protected stocks. Tips: as you can see, the S&P index is ahead of the rest, but when Bitcoin is added to the mix, it changes everything. Here is a chart of the risk-to-reward ratio of some other assets without Bitcoin, and here is one with Bitcoin. It's clear that Bitcoin is in a class by itself. Let's go back to Pal's video where he talks more about the huge opportunities that came about because of cryptocurrencies like Bitcoin and Ethereum. Here's another clip from the video.
So firstly, we observe that over time, the trend rate of GDP growth has been falling in the United States and all around the world. Current trend rate of GDP growth is about 1.75%. Why is it falling? If you remember, trend rate of GDP is driven by three key factors. 1, population growth. 2, productivity growth. 3, debt growth. So let's address these three factors. Firstly, let's have a look at productivity. Productivity has been declining over time as the workforce has been aging, and that lowers the trend rate of GDP. Debt, on the other hand, has been rising. But what we find is that household debt growth actually stops in 2008 because the banks just stopped lending to people. So it's just harder to accumulate debt. Also, corporates have also been paying off debt and have really not been growing as fast as GDP. But really, a lot of the debt growth is now driven by the central banks, as we all know. Currently, the US is running massive deficits and is financing it by issuing yet more debt. And we'll come on to that in a minute. But the key thing here, the thing that drives everything for the everything code and the world around us, the return on assets, the inflation, everything is driven by demographics. So here's the working age population, aged 15 to 64, trend rate of growth. It's been declining over time as the population ages. Those people are less productive. The older you get, the less productive you are. They had borrowed debts in their early years and now are debt tapped out. So this explains a lot, and I've talked a lot about this on Real Vision in the past. But we can also project forwards. And if you remember my piece about the retirement crisis, I've been introducing this chart for a while, which is the labor force participation rate versus the deaths rate. This is the births rate going forwards by 14 years. And obviously the birth rate drives how many people in the labor force over time. And it suggests that participation in the labor force should continue to fall over time. Now, we've had some pickup as part-time workers have come back into the workforce because people don't have enough money, and we'll see some of that too. But over time, we're going to see the labor force participation rate falling because the replacement of new people in the population is not as much as people leaving the workforce. And that is the problem that slows economies. It's affected Japan, now affecting China, South Korea, Taiwan, and most of Europe. So anyway, that is the megatrend. But this megatrend has some special qualities. When you strip everything out, and I keep saying demographics is everything, you find that the labor force participation rate is exactly mirrored by US government debt as a percentage of GDP. So what it says is as the less people in the labor force, the economy slows, but there's all of the services to pay for the old people, the government debt increases. That correlation is stunning, and that is an incredibly powerful chart to understand the world we live in today, why governments keep issuing debt, and eventually why they're having to print money to solve it. It's all a function of population. So what they do with that debt is they add liquidity into the system. That's the debasement of currency that I've talked about. And you can see the correlation between Fed net liquidity and the US government debt as a percentage of GDP. They're basically the same thing. Yes, the scaling's different, but overall, the trend is the same. So they're using liquidity to pay for the growth in debt by debasing the currency. It's called financial repression. The other stark thing that we found in the Everything Code is actually the real mechanism is that most of the government debt increase is just paying interest on existing debts. They're not actually borrowing a lot more to invest in the economy. It's basically servicing of old debts.
Some of Raoul Pal's points in this movie are hard to argue with, even if you don't agree with all of them. Things are changing quickly as we speed toward an exponential age where technology rules every industry. Investors who get in now will be a big part of that future, which means they'll be a part of the biggest macro opportunity ever, which is exactly what the cryptocurrency industry is. What do you think about Raoul Pal's view? Please share your thoughts and comments in the part below. Also, don't forget to hit the like button and subscribe button. These all help YouTube's algorithm. Thanks for watching.